Welcome to New Home Insights, the podcast from John Burns Research Consulting. I'm your host, Dean Worley. If you want to follow market trends, demographics, capital, new ideas, and endeavors that touch on housing, we're going to try to make sense of that every couple of weeks. Let's go. Hi, everyone. Welcome to the New Home Insights podcast. I'm your host, Dean Worley. Today, we're going to get a little bit technical, but also very topical. Institutional ownership of single-family rental homes and even build-to-rent homes has been a very hot topic lately. It's been really kind of caught up in this new housing bill that's winding its way through Congress as we speak. So it's become one of the hottest topics in the nation right now. Coven is an assistant professor of real estate at Baruch College's Zicklin School of Business. Baruch is part of the CUNY system, the City University of New York. He's based in Manhattan. He studied the impact of institutional ownership on rental housing extensively and has some thoughts, and we're going to hear those here today. Again, this is an issue that's very topical, but it's also inescapably political. We are going to try very hard not to be political. This is not a political podcast. So we might touch a little bit on the policy implications, but for the most part, we'll leave it to you, the listener, to decide for yourself after we present what Josh's argument in terms of what he's been finding in his research. Josh, how you doing?
Hi, Dean. I'm doing great. Thanks for having me on. I'm a big fan of John Burns Research, and I think very happy to be chatting with you guys.
I'm glad you're here. This is, as I said, this has been something I've wanted to do, and I saw some of your stuff on LinkedIn and then read it and looked at it elsewhere and thought, okay, this is something. It's not just purely an opinion. It's from someone who's, let's be honest, our clients are a lot of these people who are affected by this are our clients. So we might have a bias because of that. You don't have that, and you've done research with actual math behind it that has some really interesting findings that speaks to this incredibly important issue going on right now. So let's start with this. Tell us a little bit about you, and then give us a 30,000-foot level of what you study, and then we're going to get into it. For you, the listener, Josh studies a lot of stuff in housing, but we are going to focus very much on this idea of institutional ownership and rental housing. But Josh, tell us a little bit about Josh.
Yeah. Well, thanks, Dean. So I'm an assistant professor of real estate at Baruch College in the Zicklin School of Business. I got my PhD from NYU Stern in finance, and my main, dissertation was on institutional investors and SFR. So this is my main topic. But at a broad level, I'm extremely interested in how landlord-type differences affect households. Landlords are different, and this matters for households, for cities. I'm also interested in how households make housing choice decisions. So I study the interaction of this with taxes. I study migration as well.
So you're on both sides of the equation, aren't you? You're
yes.
on the landlord side and the renter or buyer side as well.
Absolutely.
You've presented some of your stuff at some pretty high-profile venues, though, haven't you?
I have done a number of presentations. That's an important part of getting feedback on the research.
Yeah.
And I get great feedback and a lot to work on, and then I go and improve it, and eventually it results in a sharper research product.
So let's start with this. Let's start first. Can you kind of touch on, as just generally speaking, again, kind of a high level, what are those concerns right now? And again, inescapably in the political world, what are the concerns about institutional ownership of single-family rental housing? And also we'll get to this build-to-rent housing as well.
Yeah, Dean. So housing right now is extremely unaffordable. We all know it. Rent to income is very high. Price to income is also high. It's difficult for prospective homeowners to get a home, especially with mortgage rates. And the concerns stem from these investors being located in parts of the country that have had very high price and rent increases since they've entered. These investors entered after the financial crisis, and post-entry, prices and rents have gone way up in these areas. So this is a natural concern. There's a new thing going on. Prices and rents are going up. Are they causing it?
Yeah.
So it's important to distinguish whether this is just a correlation or causation. And that's one thing I try to do, and others as well.
So that's what's going on out there. A lot of people are just equating these two events. Let's be honest, that's over the last decade plus. These things that have been happening until very, very recently, where rents have simmered down. So is there anything else that's driving? Is it supply too? Do folks feel like it's getting in the way of supply, actually diminishing supply?
Yes. Many folks believe that. So the major concerns are that these investors are driving up prices, driving up rents through concentration, and lowering home ownership because the intuition is if these companies are buying owner-occupied homes and renting them out, there are fewer homes available for homeowners. So these are the major concerns. And their entry is correlated with rising prices and rents.
Mhm.
So it's important to figure out whether this is correlation, whether this is causation, or whether
Yeah.
it's a mix of both. So
And
I try to do
especially-
this other research, and it's very difficult to tease this out
Yeah.
because
Yeah.
investors want to make money. So you make money by choosing to purchase assets in areas that will have price and rent appreciation. And they care a lot about this. So they, in their 10Ks, where I see them reference John Burns' research all the time, they talk about how they chose regions with expected job growth, population growth, and low new supply relative to the rest of the country.
And we've had those folks on the podcast here, and often I've asked, what attracts you to a given market? And it's the same things that are going to result in increase in prices. That's why they're attracted to that market. Let's talk about then in terms of what it is to be an institutional investor. The bill that's currently working its way through Congress. And by the way, I should say now we're recording this on St. Patrick's Day in the middle of March. It's only 90 degrees or so in the middle of March here. And so something might have changed between now and when this is uploaded. Josh is not responsible for that. But right now, the bill is heading towards, I believe, a House Senate conference. We don't know what's going to come out. The House and Senate both passed different bills along the 21st century road to housing. But I believe it's the Senate version has the institutional investors defined as owning 350 or more properties nationwide. First of all, just comment on that as an institutional investor. And secondly, how do you define an institutional investor?
Yeah. So 350 is not the majority of investors. Most investors in this space are very small. My research and the research of many others highlights that the majority of single family investors have 1, 2, or 3 properties. In my research, I show around 50% have 1 property, and 3 or fewer is around 71%. So most of these investors are tiny, non-institutional mom and pops. Now, 350 plus does seem like a reasonable definition for institutional. In my research, I don't define a hard and fast rule like that. I choose exactly 7 companies where I know exactly what they're doing. This way, I don't have a lot of dark matter in my research.
Okay. 350, honestly, again, maybe I'm biased. I probably am, but 350 doesn't seem, it's technically institutional investor, but is it the kind of institutional investor you might have to worry about in terms of market concentration? It can't be. That seems like a crazy low number.
Well, the ones I focus on all have more than 10,000.
Okay. There you go. That was actually my next question. So typically, these larger investors are thousands.
Yes. Invitation Homes, American Homes for Rent, these companies have tens of thousands.
And dispersed over multiple markets throughout the country.
Yeah. We're talking 10 to 15 markets.
Yeah. 10 to 15 markets. And then within markets, usually multiple submarkets within those MSAs. So how much, just in your sense, if we were say, do you know, tell me if you don't, but if we were to say like 1,000 units or more, what is the control? Isn't that something like a lowish single digit in terms of the single family rental world, residential world?
Yes, I have the numbers up here.
Okay,
there's the latest report from the American Enterprise Institute, and they say that the 1,000 plus, they own 0.5% of the single family units in the country. And that's a larger share of the single family rentals, but it's still not a very dominant share of the single family rentals. But this is more concentrated in metros. There are many people who say they don't matter nationally, but they do matter in a few specific metros where they're more concentrated.
Okay.
Like Atlanta, Phoenix, Tampa, Charlotte.
But the reality
in these
is
metros, maybe they have 3 or 4% of all the homes.
Okay. So still a pretty narrow level of ownership, even in the places where they're sort of overrepresented.
Right.
Okay.
But in some zip codes combined, they can own up to 10% of the homes in a few of them. And these are where the concentration concerns mainly come from.
We'll get later on in terms of if that's enough to be sort of a concentration of power. I wanted to follow up with, haven't those actors, though, slowed down their purchases pretty dramatically in most places the last few years?
Absolutely. Many of them are net sellers right now. They did most of their buying starting in 2012 after the financial crisis when there were a lot of foreclosed homes. And in this time, they were actually seen as desirable. They were actually seen as stabilizing the market that was in free fall due to the financial crisis. So they purchased in the teens, then they slowed down. Then at the start of COVID, they purchased more. But since 2022, they have not been net purchasers, they've been net builders. They've
Yeah.
shifted to build to rent. And this seems to be because some of the liquidity has dried up. It's easier to build now than buy, but also I've spoken to some operators and they've talked about how the margins are better when you can build all the units the same. It's just easier to operate.
Okay. And so the irony, though, of the timing of this is amazing because it seems to be a solution in search of a problem, but at least right now. I mean, if you can give them the benefit of the doubt and say policymakers are thinking in the long term, I suppose, but right now it's odd because it wouldn't have much of an effect.
Right now, they're not net buyers. They do some buying just to recycle capital.
Okay.
So a ban right now would get in the way of that, just regular recycling, even if they aren't net buyers.
Okay. Josh, let's talk about what is present and what is going through Congress right now. What are kind of the main points in terms of the topic we're talking about right now, institutional investors, of this bill?
So the point I see in the Senate is investors with 350 plus units are prohibited from buying more. The Senate does not want them to sell off these units, just a prohibition on buying. And they would they're allowing build to rent, but with the rule that they have to dispose of the build to rent within 7 years.
So you built an 80 or 100 or 200 unit build to rent community. You have to get rid of all 80, 100, 200 of those homes within 7 years, correct?
That's my impression.
That's what it sounds like to me too, which is, I mean, we'll get to that in a little bit, but I'm deeply sighing. What do you think this does to single family? Do you think this has, and we'll get into your research here in a minute, but just top level, high level, what do you think this does to single family? And then I'll ask you that same question about BTR.
So the question, there's still, we don't know exactly what's going to happen with the bill first. I think if the bill is passed as is, I certainly don't know how the institutional SFR will respond, because if they're prevented from doing the regular capital recycling, I don't know whether they hold their unit steady or whether they slowly exit the market. This is also a pretty negative signal that they're not seen as a part of the desirable environment, and then they might leave. So if there is a sell-off, this would put downward pressure on prices, and then on the other hand, shrink the rental supply and put upward pressure on single-family rentals. The build-to-rent provision, you would know more than I would here, but I imagine that the 7-year disposition is not desirable for build to rent, and that would lower the amount of build to rent.
It's a non-starter. I think it destroys, I think it decimates the build to rent industry. I mean, 7 years is, even if you want to dispose of it in that timeline, it leaves you such a short, you would have to figure out how you're going to do it. You'd have to try to time the market, and you're backing up against a fairly short timeline in which you'd have to time the market before that timeline ends. And then you're just sort of forced to whatever the market forces are and dynamics at the time. I think it virtually ceases to exist in terms of new BTR. That may be an exaggeration.
That was my initial guess as well, that it would be pretty negative. And to the extent that build to rent adds to the total supply, this would then lower the number of total supply.
Which would have an impact on pricing, right?
Yes, it would.
Yeah. So let's talk about your work. So very, very, very broadly, just kind of recap a little bit here, and then we'll get into some specifics of it. But high level, again, sort of recap what you're looking at in terms of institutional ownership and SFR.
Yeah, so I study institutional investors entering the market, and I'm interested in their impact on prices, rent, and homeownership. And I study this by studying the cost structure of institutional investors, the cost structure of small mom and pops, how households choose where to live and whether to own or rent, and also how builders respond to movements in prices. And I think about these 4 groups and how they would respond to institutional investor entry. So I estimate the behavior of these groups, and I have institutional investors enter the market in a simulation. And I find that they do have an impact on prices, because if you increase the demand for an asset, price is going to go up. The question is how much. I find that they don't broadly increase prices in the country because they're only in a few select markets. And where they do enter the market, they do have a price impact, but it's much smaller than the amount that prices rose without their presence during this period.
Okay,
so
we're going to tease that out here in just a minute. But how about in terms of the timeline? When do you start your timeline of sort of when these actors became an important thing that we should be looking at?
Yeah, I started in 2012. I analyzed from 2012 to 2021.
I know a minute ago you said you don't have a hard and fast definition of an institutional investor, but have you always been thinking of those folks as entities with thousands of units?
Yeah, tens of thousands.
Okay. Let's tease out the amount just a little bit here real quick. What are there some markets where what are, I guess, the sort of those top markets where you have seen a more significant amount of institutional activity?
Yeah. So Atlanta, Phoenix, Tampa, Charlotte, these areas.
Those
My
classic Sun
paper,
Belt high growth.
right. They predicted where prices and rents would rise based on demographics, and also they had a unique buying opportunity in these markets because of the foreclosure crisis. There were a lot of foreclosed homes and they were
Yeah.
able to get these at discounts. And in their earnings statements, they talk about how they want areas with a price discount relative to pre-financial crisis and how
Okay.
that drives expected price appreciation.
I know that. So there's been a pretty extensive diminution in their activity lately. Generally speaking, though, are they still looking at those same relatively high growth markets?
Yes, they tended to choose those markets initially and then infill from there.
Okay. Which is interesting because some of the stronger markets here these last couple of years have actually been those Midwest markets and some of the Northeast markets, but the Midwest has been some strong markets lately.
Yeah, they do have Midwest exposure in Ohio.
Are you tracking data on build to rent or is it just mostly SFR?
Mostly SFR. I would love to get data on built to rents, but it's harder. I can see what I see in the earnings statements, but to really do a true estimation of how much additional supply they bring online relative to if they didn't exist, I would need really good builder data.
And that's the difficult part, isn't it? Right? Let's talk about that for just a second. It might be a little bit of a sidetrack here, but the idea is that build to rent diminishes supply, which seems to be something these policymakers are taking as granted. Is what? Is it that otherwise that same unit would be built and sold to a person as an owned home? Is that the thesis?
That is the thesis. Yeah. So look, it's possible some of that is going on, but I think the total amount is going up. There are reports that there are huge synergies between builders and landlord and large landlords. For example, they could design many units at the same time with no idiosyncratic modifications. They can do the permitting and all that for all the properties at once. They only have to deal with one company versus many homeowners. And all of these will cause it to be lower cost to develop these units, which means that the total number of units developed can increase. Now, how many of these would have gone to homeowners is an empirical question, which needs to be estimated.
And would they have built it if they were studying it as an ownership? Because it's a very different dynamic. It can mostly completely different market. The Venn diagram is not nearly as much as some people might think, certainly as much as they appear to think. And also, some of the folks who do BTR, and obviously this you can consider this self-serving, but I also think it's very true, is that they're able to present and build rental housing in neighborhoods that those folks with those same incomes would likely not be able to own.
Yes, absolutely. Many reports have shown that people who rent in these institutional owned homes would not be able to purchase homes in the same neighborhood. And my research shows this too. In my research, I'm able to see which exact homes are owned by institutional investors, and I have migration data. And I can see where people come from who move into these homes. And I see they came from areas with lower historic economic opportunities, lower incomes.
That's an interesting question. Let's do a little brief demographic sidetrack. So when people are moving into SFR, I'm guessing they're mostly from that same MSA by far, right? If people are coming, I don't know if you've teased the data out this much, but if people are coming from a different MSA, from outside of that area, do they tend to come from relatively low income MSAs?
I don't tease it out by same MSA versus different. I mostly focus on, are they coming from lower income regions?
So let's talk big picture. Let's do some math. Again, we have to do some math here. We're going to try to stay as non-technical as possible. But what have you found has been the impact on, first, let's talk about supply from institutional investors.
So I find that they substantially increase the rental supply. When they purchase one home and turn it into a rental, that increases the rental supply, in my estimates, by half a home. And the reason it's not one-to-one is because they do some buying from other investors.
1,000 homes is 15. is effectively 1,500 in that that's 0.5 per unit of change.
Yes,
Okay,
0.5 increase in the rental supply per unit they purchase.
got it.
I find that for each unit they purchase, builders build around 0.3
Okay, interesting.
also, because I do find that they have a price impact in their most concentrated regions. And if they do have a price impact, this causes builders to build because builders want to build when prices are higher.
What do you think the cause of that is? Is because these folks have the wherewithal to create supply? Or I don't know. What do you think the cause is here?
So that's not included in my paper. In my paper, I focus on the fact that they're buying in the suburbs of
Okay.
Sunbelt cities, and these are areas where builders are able to build. If they bought
Okay.
in Manhattan, this would not be the same thing.
Yeah.
The impact on homeownership would be larger and the price impact would be larger. But because they're doing the suburbs of Sunbelt
Yeah.
cities, there's a much smaller price impact and a much smaller homeownership impact.
Yeah. Especially the supply part. You're right. In those, they are concentrated in areas that are relatively, let's call it pro-development or ease of supply and barriers to entry relative to places like California, New York, where that's a different story.
Right. And this is potentially an underestimate because this doesn't include the synergies that we just talked about with build to rent. So it's
Okay.
possible that they make builders even more responsive to price increases than when they didn't exist
Okay.
through build to rent.
Through build to rent. Okay. Supply. So your research has found that supply is actually increased by, let's just call it generically, institutional activity, the presence of these large institutional investors in the housing market. Let's go price. What have you found has been their impact on price?
I find that in most of the country, they didn't raise the price. In their top decile of regions, they did raise the price, but by less than the price increased in this time period. So in the top decile of regions, they're responsible for at most 20% of the price increase that happened during this time. And in most regions, they're not responsible for a price increase.
About 20, I think it was 22%, I think something like that in your...
Yeah, something like that. So economically meaningful, but they're not the cause of these broad price increases.
And so why are you focusing on that top decile, meaning top 10%? What does that mean in terms of the markets? And why are you focusing on that part of the market?
Yeah. The way the research works is their demand shock pushes up prices because if more people want the same number of homes, this pushes up prices. And then builders respond and increase the number of homes. So the price impact scales with how concentrated they are, how much purchasing they do. And so these are parts of Atlanta in my model. Yeah.
Got it. Okay. Just Atlanta at the top decile, or is it multiple different markets across the country?
So in my paper, I focus on just Atlanta.
Got it.
But I
So
do a
you're
lot
trying
of
to find a
summary
geography.
statistics about the whole country.
Okay. Got it. So you were trying to find a geography that had good source of data, et cetera, and you can...
Yes.
I mean, is it fair to extrapolate that to at least markets similar to Atlanta?
Yeah. So one thing I do is if you're considering extrapolating it, I try to talk about which economic parameters are most important to think about their impact. And the most important one is how builders respond. That's one of the most important ones. So I run some simulations where I say, what would their impact be if they bought in an area where builders couldn't respond?
Okay.
If we shut off construction entirely,
see.
and the price impact would have been more than twice as large. The homeownership impact would have been almost twice as large.
So they're spurring supply in those areas where supply can at least run more or less freely. But in places where there's just a constraint, that probably would have more of a price impact.
Exactly. And this is the case across all sorts of demand shocks. Like if you think about anyone wanting more of a good, the more supply can respond, the less that increases prices.
Yeah. I mean, that's the nut of it. And that's the obvious thing, which is one of the things that seems so extraordinary about, especially the BTR portion of the current bill. It's the impact of that is so obvious, and they want prices to go down. That would, without question, cause prices to go up. Otherwise, all else equal. How about in terms of just a more kind of the gut level idea? So you said like institutional investors they don't control that as much the market as I think everyone in the world thinks, but they are for the most part rent maximizing people. Is there an argument to be made that, the mom and pops are not always rent maximizing? They may be looking for tenant stability or something like that. Do you think that the more professionally run folks would likely, all else equal, raise prices a little more than mom and pops?
It's certainly possible, but what I try to see is if the market power is a problem.
Okay.
Not whether their higher professionalism is a problem necessarily. I try to say if they own 5% of a zip code, should we be concerned that they're artificially inflating rents? And I try to think very carefully about that. And In real estate, you can raise rents in lower quantities in one of two ways. It's not necessarily iPhones or cereal or beer where you could just withhold and then the price goes up.
Yeah. Pliny the Younger.
What was that?
Pliny the Younger. It's a classic beer that they release it once a year, and it's incredibly sought after. Totally artificial scarcity. Sorry, everything's a beer and a beer connection with me. Go ahead. Sorry.
Yeah. No, but real estate is different. If you withheld most of your units or some amount of your units, you still have to pay property taxes, you still have to pay insurance, you still have to pay interest. And because the holding costs of a vacant unit are high, it's not incentivized for real estate owners, especially in single family, to hold excess vacant units.
Got it.
And so I look closely at the data in the 10Ks. You can see occupancy for Invitation Homes and American Homes for Rent is super high and does not decrease after a merger between Invitation Homes and Starwood.
Okay.
And turnover also does not increase. So the data to me say that what's going on is not that they're restricting supply to raise rents artificially. Instead, the way they exercise market power is different. It's by not oversupplying their own market, which has just different consequences.
Yeah. So they're careful about supply because they're thinking about the result and the return on that, which is just normal. I mean, that's normal business in any sector at all. So is it fair to just super generalize that typically institutional investors have not impacted pricing in a way above kind of market forces around them? Does that make sense?
For rents, I would say yes.
Okay.
Yeah.
Okay.
Yeah. No, I try in my paper to think very carefully about it, and I propose a number of conditions at which this would be a problem. So if they're holding a lot of units vacant, that would be an issue. If they're on net crowding out more other types of landlords than they bring online, that would also be an issue. And if they're blocking new construction. But the data does not support this. The data says occupancy is very high. They didn't crowd out all the small landlords. Still, many of them are there. And instead of blocking new building, they seem to be increasing the amount of new building through build to rent.
The latter is, in my mind, unassailable. It doesn't make any sense otherwise. Some people think, has this led to a decrease in home ownership?
So I think there has been a home ownership impact, but it's much smaller than you would think if you didn't think about supply. So this is another thing I try to bring out in my paper is you might think that if these companies buy a home and convert it into rental, that's one less home for a homeowner. But when they buy a home, they buy some from small landlords. And if they have a price impact, builders increase the amount of building going on in the area. So I estimate instead of 1 unit fewer for homeowners for each purchase is closer to 0.2, 0.25. So this is around 4 times smaller of a homeownership impact than if you didn't consider these important supply forces.
Okay. Is there any generalization of who those homeowners are? Are they entry-level buyers that have maybe been affected?
Yes, it does seem that way.
How about, but you can go back to the other argument is would they have been able to, those same households, would they have been able to buy those things as present? That's where I guess it gets very tricky for you to do that kind of
thing. So the people who are renting currently from institutional investors, it does not seem like they would be able to buy in their market. But the people who lose out on homeownership are those on the margin.
Okay.
So they're not necessarily the same people as those who are renting.
And just to be clear, because I can hear many of our folks who we know in the BTR world, especially in the single family world, they're going to tell you that demographically, their folks are virtually indistinguishable from homeowners next door. But a lot of them are renters by choice. And sometimes when it's not, it might be more of a down payment or something like that. That is the stumbling point. But in terms of incomes, in terms of other demographic markers, they tend to be very, very similar to those owners next door.
Yeah, this is a really good point. And thank you for raising it, because many people might want to live in these neighborhoods and have the single family home lifestyle without purchasing. And it does seem like there's high demand for single family rentals. And some people might not have the down payment, but have the income. And this is desirable for them.
I'm going to talk about one more thing in terms of your research, and it can get potentially technical, but try to sort of dumb it down for us. You talk about the economies of scale are the key impact on institutional investors is not necessarily market power. Can you just sort of explain that a bit?
Yeah. So we talked about how these investors increase the rental supply on net. And if market power were the dominant force, it would be because they decrease the rental supply. But what's going on is they are very efficient operators. They're on average operating at lower operating costs than the average mom and pop. And because of that, that causes them to buy more homes and supply more rentals. And so this is the driving force, that they have scale economies, they have efficiencies, they can provide these rentals for lower costs because they're large.
Yeah.
And because they got in at a time where it was easy to accumulate the scale.
Yeah. Yeah. That mom and pop, if they have 3 homes, they might have a property manager, but that per unit cost of that property manager versus thousands of homes across usually internal
The
employees.
property manager could cost 10% of rent for a mom and pop. Whereas for an institutional investor that owns their own, property management company, it's not 10%. It's much less. So.
Okay. So let's talk about size though. Is there a point where you do have, what would be the market concentration level you think, where you would have some potential for these actors, institutional investors, to impact price in ways that aren't purely market driven?
Yeah, I would need to estimate that from looking at concentration levels and their effect on vacancy. So it would have to be a large enough amount that it would be profitable for them to withhold some units in order to raise rents.
Yeah.
And because I haven't observed that, that's hard for me to say. But it's not the present levels.
You're just pure gut. Do you think there are any zip codes or markets or submarkets where you do have some institutional actors becoming a pretty fair size of the market, depending on how we define that?
I think a fair size, some zip codes certainly.
Okay.
But not a concerning size, because again, there can be multiple of them, and I don't think it's more than 10% in a zip code.
That you know better, obviously this more than I do, but 10% does. I don't think, especially that 90% is distributed across a lot of actors. I don't see how 10% gets you any kind of significant market power. We can kind of control that market.
Sorry. I want to be a little more clear. They could have much larger share of the rental market. Than 10%.
Oh, I see.
But
got it.
Yes, even this larger share of the rental market, it could be distributed among multiple actors.
Okay.
And if they're not withholding units from the market, that's not a huge issue.
And why would
they? For renters,
yeah, okay. And why would they withhold? That would be odd. It'd be not something. I mean, think about it. We have experience with apartment operators, for decades and decades and decades, and that's not something we ever have worried about with those folks.
Right. No, in my paper, I try to talk about when it would be desirable to withhold and when it wouldn't.
Okay.
And an important thing is how easy it is to dispose of an excess vacancy. And in single family, you could just sell a vacant unit to a homeowner.
Yeah.
And in multi, that's harder to sell one unit of your property.
For sure.
So you'd be more likely to see this in multifamily than in single family.
Okay. Have you seen any hint of market power, and even on a micro level? Or is that an unfair question because you haven't looked at it at that level?
So I do see market power. I want to be very clear. I see market power in they're not oversupplying their own markets, but I don't see it in them holding units vacant.
Okay. And I guess when I'm saying that, I mean the dependent variable would be rents, wouldn't it? It'd be have them able to push up rents, maybe quote unquote above market due to any kind of concentration.
So in my research, it's hard to separate this from the net effect of their increasing the rental supply.
Okay. Yeah.
What I can do is I can say if there's a merger, maybe they would sell some more of their units to homeowners, and then rents would be higher than if there were no merger.
Okay.
But rents are lower than if they never entered, because they're low-cost operators who are very efficient and on net increase the rental supply.
And generally speaking, again, going back to generalizing your findings for the layman, you're saying effectively that these actors have been increasing supply net. I mean, doesn't that kind of have to, in classic economics 101, lead to all else equal lower pricing?
Yes, it does put downward pressure on the rents.
Okay.
But yeah, their demand for owning homes puts upward pressure on the prices.
Okay. I want to come back to BTR, build to rent, here for a second. I mean, we talked about that. In my mind, I think that 7-year rule just decimates that sector. What do you think from your perspective? Do you think that's what would be the impact on BTR from the 7-year window clause?
Yeah, I would expect that ties their hands quite a bit. I'm not an expert in the operations of BTR, but I would expect they want to hold these properties for more than 7 years, or at least have the flexibility to do it.
Do you have any thoughts on whether the development of BTR does deter or has an impact on the development of own homes, of for sale homes?
I'm not sure.
Yeah, okay.
I think it's very likely that BTR increases the total number of homes that get built.
Yeah.
I feel fairly confident in that because of all the reports of the synergies between
Yeah.
building and renting. I mean, in multifamily, build to rent is what is the name of the game.
Yeah.
And all of this is just single family innovating to become more and more like multifamily.
Yeah. So that is zoned for residential or whatever to be rezoned residential, whether it gets purchased and developed by a for sale entity or for a rent entity, is adding a unit of housing to the overall supply of housing in that market. It has to. It's not like you could make that argument for something like Airbnb or something like that, where you're essentially turning that unit of housing into kind of a hotel. But I don't see how they make that argument and they have this clause for BTR. It seems like it can only diminish supply, and that's not their stated purpose.
Right. I think it can definitely only diminish total supply.
Okay.
Right.
Okay.
But it's possible that politicians don't care about total supply.
I feel like they do. I have heard, and let's do a brief little sojourn here toward the end of this podcast on the policies and your take, not so your take on the policy, but your take on the impact of this housing policy that's coming. And again, just to reiterate, we're doing this in the middle of March, so things could have changed by now, by the time this uploads. But let's talk about first supply. Generally speaking, from what you know about this 21st Century Road to Housing bill, how do you think that's going to impact overall housing supply?
So I really know best about the institutional investor component.
Okay.
I would not say I'm an expert on these other components. I think in general, deregulating, making it easier to build will increase construction and lower prices and increase the numbers of homes supplied. The institutional investor component, the 7-year disposition requirement seems very difficult for build to rent. And I would imagine that would lower the amount of build to rent and lower the total amount of construction.
Okay.
But these other components of the law that don't pertain to institutional investors, I'm less knowledgeable about their specifics.
Okay. I mean, ultimately, wouldn't pushing investors who have the wherewithal and capacity and expertise to build homes, if you got them out of the market, wouldn't that just kind of have to diminish supply?
Yes, if construction gets less efficient, then it's more costly to build a home, and then you'll have lower homes in equilibrium.
I don't want you to go on too much of a limb here, but are there some housing policies, and it doesn't have to be on the federal level, but on the local level, are there some housing policies that you think folks could pursue that would positively impact housing, especially housing supply?
I think deregulation and upzoning, just making it easier for builders to get from the start of the project to the end, like speeding up approvals, less layers of approval, and more upzoning. I think these would be broadly helpful.
Yeah. And in fairness, the 21st Century Housing Bill does have some elements of it that are doing that. It's not just solely, we're talking about the SFR and BTR impact of it, but it does have some things to thin out regulation and things like that could help.
Yeah, it seems like it. I'm just not an expert in the specifics of the other parts of the policy.
If you had to pick one takeaway, I'm going to put you on the spot, one takeaway from your research, what would it be?
It would be that we shouldn't be as worried about market power and single family rentals as we might be inclined to be. It doesn't seem like it's the dominating force here. It seems like the dominating force of institutional investors on rents is that they increase the supply of rentals and push rents down.
Yeah. And I'll say on my part that the build to rent part of it, I mean, we want that. We should want that. It adds to supply. It enables folks to get into a good home in often some areas that they otherwise may not be able to, or at the very least, it just adds supply that is desirable. And clearly it's been very successful. It's nuts. My best guess is that they simply didn't think through the ramifications, particularly of the BTR part. I think the SFR part, I'm not saying it's a good policy, but I think they thought about that. But the BTR part, it seems like it was tacked on. I don't know by whom, and it just was not given much thought.
Right. Well, we'll see. We'll see how it all ends up.
You know, last question though. What's next for you? What are you doing right now in terms of your research?
Yeah, I'm continuing to study institutional investors. That's a part of my research agenda. So one thing I'm interested in is the differential ability of different landlord types to bear climate risk.
Oh,
I think it's possible that institutional investors, like I see in my research, they have lower insurance costs, they have lower cost of capital, and they're geographically diversified. So this could make them better able to own climate risky properties for
hmm.
less cost than other types of investors. So I'm very interested in testing, is this true? And what are the implications for places like Miami and other climate risky areas?
Your stuff is ripped from today's headlines. That's also very, very topical. That's interesting. Okay.
That's how I get my ideas. Yeah.
I love it. Josh, thank you so much for coming on the show. This has been great.
Well, thanks, Dean. Really appreciate it.
Absolutely. This is Dean Worley for the New Home Insights podcast. We'll see you again in a couple of weeks. Since you forgot to hit the stop button, I'm going to take a second to tell you about our weekly Building Market Intelligence newsletter. Over 40,000 smart folks get these timely takes on the housing market in their inbox every week, and you can too by heading to jbreg.com/subscribe and signing up.